Saturday morning to everybody, and welcome to On the Mark with Mark Papa from Financial Resources Group. You can contact him very easily. I say start off with his website. It's www.frplan.com. That's frplan.com. You can also, by the way, he's got a real hot YouTube channel. So if you miss any portion of this show or any of the previous shows, head on over to YouTube, and then you want to go to Mark Papa. Just type in his name, MarkPappa 5207. That's what you want to. That's what you want to plug in the search field on YouTube. And you can also check out his website. He's got a link there that'll take you right to YouTube. And write this phone number down. Better yet, use it. 860-657-8380. 860-657-8380. And you can call him at the end of this show. You can call him during the show. You can, heck, if you want to wait till Monday, you can wait till as long as you call him. There's never any obligation with a consultation. Well, good morning, Mark. Great to see you this morning.
Hi, happy Saturday, Gary. How are you?
Happy Saturday, bright and early on a Saturday morning. I'm not doing too shabby. How about yourself, man?
Again, as always, I can't complain.
How was your week? Busy?
Yeah, things are picking up. It's a special time of year. Mm-hmm. It's almost
tax season, right? That's what it's.
Yes, it's tax season, and I know full and fair disclosure. I also have a small tax business, so it's not small anymore. Glastonbury Tax Pros, or www.glasstaxpro.com. And, in thinking about what was I going to talk about today with Gary and coming up with content, well, this is a perfect opportunity and time to be talking about taxes and also tax planning and taxes and retirement. So why not? Why don't we just get at it? Now, I'm sure, Gary, your forms are just arriving in the mail. You're getting everything in, and it's that time of year where you're just checking the mailbox every day for those forms or checking your email, right?
I have all my forms finally. Now it's a matter of submission.
Aha. Yeah, that's awesome. It just takes a little bit of time and energy. And just like anything, Gary, I guess, it's I just wanted to get into that and talk a little bit about, Benjamin Franklin's famous quote in his letter to Le Pen. And what are the two things that we can't avoid in this world?
Death and taxes.
Death and taxes. We probably hear that a lot on your radio show.
And the Dallas Cowboys choking, right?
Yeah.
Oh, that's three things. I'm sorry. I'm not even a Cowboys fan. So.
Yeah, I know. And it's so the Cowboys. And then, the other thing would be there's another famous quote that we like to bring up to people. In 1910, there was a judge by the name of Learned Hand. And he says, according to the Constitution, there's nothing in there that says you're obligated to pay the most in taxes, and that, it doesn't mean you're a bad person. In fact, you really are only obligated to pay what your fair share is, meaning, the least amount of taxes that, the law states. So what I want to do is today...
Is that true? I mean, if I just said this is all I'm really going to pay, that's all I can afford, they're going to be okay with that?
No. So that would be tax avoidance. So in this case, what we want to talk about are strategies or ways that we can pay the least amount just by planning ahead, making smart decisions, thinking things through, versus a lot of people just go out and say, okay, I got to make as much money as I can this year, work the overtime. They forget to add money to their 401k plan, event to bump up their contribution. Sometimes they mistitle their forms so that they don't have enough money withheld on the W-2. But paying more to the government's not the strategy here. What I want to talk about today is just give people just conceptually ways that they can actually lower their taxes during retirement. Okay? Or even while they're working, for that matter, so that they can actually have a healthy retirement. But, the judge was basically saying that, you're not obligated to pay the maximum amount of taxes. You're only obligated to pay the least amount of taxes. That's your goal as a patriot. And I think there's a lot to be said about that. And again, it's just a matter of my goal is to help people plan ahead. So if you go to that other website, taxpro.com, you'll see a focus.
Can you
on
spell
planning.
that glass as in Glass? Or I know you're out of Glastonbury, so is it one S?
Yeah, it's short for glass, right? GLASTAXPRO.
Glass Tax Pro.
Okay. Yep. And now that business is essentially fully integrated with my financial planning. So you go to most places, and again, don't use anything I say. I'm not going to be liable for anything you hear on this show. If you go try and do it on your own, get some tax advice. If you're not going to call me, get some tax advice. I would urge you to call me, but get some tax advice from a licensed professional, a CPA, or someone who's got a depth of knowledge in taxes and experience. And not somebody who was referred to you from a friend or some guy who gets big refunds in Florida. No, we don't want that. We want good people, good quality folks with a good background. So anyway.
Makes sense. Good.
Yeah, and I've been doing this for quite a while. So I've been doing taxes since 2006 and started an office in East Hartford, of all places. Mm-hmm. And I worked for a national tax chain called Jackson Hewitt. I don't know if I'm allowed to say that, but
I'm sure you are, yeah.
And
but we have a buddy that used to own a Jackson Hewitt.
Yeah, I was with him.
Oh, were you really, Jeff?
This is the funniest story ever, is I had never done my own tax return. So for those folks out there who are TurboTaxing it and trying to do it on your own or free file, if you get a super, super simple deal, fine. But we were doing, your standard W-2s and in the very beginning just actually earned income credit, tax returns. People coming in with, $12,000 in income, 2 kids, an unemployment slip, maybe net $18,000 were generating $6,000 refunds for themselves. And just for the audience, this is a quiz for you. Okay. And I don't expect you to know the answer, but if you do, you wouldn't shock me if you did.
You know me too well.
There's a famous president who actually, in the 80s, I just gave it away, came up with passed the earned income credit. So it was actually a Republican.
Yeah. 80s president, huh?
Ronald.
Well, I was going to say there was really only 2, and one was the vice president while Reagan was president.
Yeah, so it was Ronnie Reagan.
Yeah.
So he came up with this strategy then, and it was an incentive to work. So anyway, long story short, I'd never done my own tax return. We had to build out the office. We had about a month and a half to get ready for tax season. And I basically learned doing all these practice returns because I was the manager of this place. I had no idea what I was doing. But wouldn't you know, by the time I got done with that first season, we did over 550 tax returns in the town. We had no audits, very little mistakes, at least not on my part. I learned how to do taxes fixing all the problems that all the preparers didn't know how to fix. And I just got thrown into the buzzsaw. And then it turned out that I actually got pretty good at it. Learned how to do rental properties, learned how to do some small businesses, and you just roll from there. And, in 2011, I had a falling out, which at the end of the day, not really a falling out, but it was time to go anyway. Mm-hmm. And I'm on the highway at this new position with Financial Resources Group. And I realized that it's only March. And I'm like, well, I've got about 110 people on my phone, and I'm stuck in traffic on 95 coming back from my very first appointment in Greenwich that I got referred to.
It's a great client to have one in Greenwich, huh?
Yeah, they were nice people, client. Actually. And wouldn't you know, I started dialing my phone. I'm in traffic. Have you done your taxes yet? No. Have you done your taxes? And I gave them the story. They're like, okay, well, we'll come see you. So by the end of the season, I had 110 tax clients to get started with. And that paid me right away. I didn't have to wait. So prior to that, I was like just getting paid W-2, which is painful. And I have to wait all year to get my full paycheck for all the hard work I did over the 4 months. So that's why I started my own Glastonbury Tax Professionals through a CPA, Roy Lewis, who brought me in, who's tremendous as well. So I thank him as well.
How long have you been with
Oh, God, been doing this now. It's 2025, so it's almost 14 years.
Wow, okay.
I've been doing taxes since 2006.
In every year, the tax laws change, right? So you've really got to stay up to date on all of these.
They do change. You have to stay up to date. And, a lot of people, when they do presentations on taxes, how many people in the audience, want to know, that their standard deduction went up a little bit. There's all these articles. There's so much information about, okay, your standard deduction's higher. The tax brackets have changed a little bit. There's all sorts of new laws.
Let me ask you a question. All right, and I want to keep it very simple because
I don't want to be like the IRS manual. I want to talk about how people can save money on taxes.
Okay, it's to that point.
But no, those are great questions too, Gary. So bring them on.
Okay, I'm going to keep it real simple. Let's say a person makes $100,000 a year, okay, mm-hmm. and they were to take their W-2 to X, and bear with me here, and let's try to do a side by side, and they were to take their same W-2, $100,000 a year to accountant Y, okay. Would both accountant X and Y come up with the same result as far as what that person would be I don't know, paying or receiving from the IRS? Or does each have their own set of background where they know how to find legal loopholes or using the law to your advantage? Or is the answer the answer?
Well, you would hope that they'd have the time to sit down with that customer and say, okay, what is going on with your 401k plan? Are you maximizing? The one problem I see out there is, well, first off, $100,000 isn't enough to live in the state and without max your 401k.
I just try to keep it easy because it's a round number.
I would say max out your 401k, and most people tell me, oh, I do the match. Okay, what's the match? Well, 3%. Okay, so you put in 3%. How are you going to retire if you're only saving $3,000 a year or $4,000 a year in your retirement? You better hope you're just not going to do it. Yeah. So I say, are you aware that you can increase it to, even significantly more than that, up to, $23,000, and then if you're above 50, you can do up to $30,000.
You're talking about a 401k?
A 401k plan, you could do that. So
I thought what's limited at $8,000 a year? Is that a Roth IRA or?
Yeah, $7,000 for below 50 and $8,000 with the catch up.
Okay.
So, and as long as you don't get phased out, so those people can also put some money if they have other money and they're a good saver, put money in a Roth IRA without being penalized. If they're single, there's phase outs for singles and married. So I didn't exactly bring those figures with me, but most people are below that category and be able to do that. Other people can also use the Roth component of their 401k plan. Some people split it 50-50. A lot of the smart people I know do, knowing that they'll have, half their retirement will be taxed and half won't, but that'll put them in a much lower tax bracket in the future, which is a good thing. Okay. So there's a lot of different things people can do. But I would say the outcomes will be different. But if you have two really good, solid CPAs, I'm sure they're going to let them know to do those things. And in my practice, I do that as well. It's about the planning. But the problem is, Gary, when you come to me, once 12/31, the end of the year happens, it's too late. It's almost too late to do things unless you have a small business. But it's almost too late. If you're a W-2 employee, the die's been cast. You're going to basically pay whatever the government tells you, whatever their software tells you to calculate. That's it. You're done. Then you're going to pay whatever you pay. And if you set yourself up right, you might get a little refund on that, a state and federal refund. You just have to make sure your forms are correct.
Maybe have them take out a little bit more than just what they would normally take out.
It's either take out more, or what I like to show people is this is what you actually pay in taxes. What if we can take a couple $1,000s off that bill? Would you like to add another? If you put another $10,000 in the 20% bracket, and you put another $10,000 in your 401k, it's $2,000 in your pocket plus the match. You're saving a lot of money. Now, $2,000 doesn't sound like a lot of money to people, but you add up $2,000 over 10 years or 20 years, and you add the compounding. That $2,000 is 10 years. It's a double, so it's like figure. That can be worth a lot of money one day that you're leaving on the table. So those are just the little things.
Okay.
Those are that's the basic version of tax planning. Would it be okay if I talked about some of the more complicated?
Yeah, you probably should.
Okay. Well, here's the problem. It's not complicated.
So much for the more complicated then.
It doesn't have to be at all. And if you make it complicated, then you're just trying to, I think a lot of guys, people who make things complicated only do so that they make themselves feel important, unfortunately. At least that's what I've said. It doesn't have to be complicated. And I can break it down the same way you just did. So I actually have live examples of this, and I have a software. Okay, so the first software I have is called Tax Clarity Software. Okay, and it's a software that lets me run these scenarios for people. So like you said, what does it look like, Mark, if I put more money in my 401k? Obviously, your tax bill is going to go down. Versus, okay, taking more out of my paycheck. Well, why don't we balance that out? Let's say, okay, maybe you can't afford to put that much away, but what if we put in a little more, and instead of going from the 12 bracket, instead of the 22 bracket for that income, we're going to drop it to 12.
That'd be nice.
Right? So you're saving 10% right there.
Sure.
On whatever money you put in. 10% is 10%, right? I mean, here we are. We see eggs go up 10%. What's everybody doing?
Panicking.
Everyone's panicking. Gasoline goes up. Panicking. But it's hard to see money that isn't, So I also do, on a tax savings, I like to put cash in a safe in my office, and I actually make people count out the tax savings in real terms with $100 bills. And when they do that, guess what do you think the impact is if I just tell them a random number?
Well, of course, like anything else, when you see it as opposed to hearing about it, but you're seeing it with your own eyes, that's a lot more impactful.
Oh, yeah. It's like the difference between paying cash for something or credit card. If you brought a pile of $2,000 into a Costco versus your $2,000 on your credit card, how much more conservative are you going to be with the $2,000?
A lot more.
A lot more. And I bring that because I got a pretty nice Costco reward. And the last time I went in, I went like mystery shot. I went crazy trying to buy stuff with my rewards. And I'm like, okay, I don't need another steamer. I don't need more food. And I ran out of stuff to buy. And I walked out there with like $500 or $600 in cash. And I'm like, I'm worried about getting robbed on the way to my car, So, but those are great rewards. So what I did was you transfer to my bank account. And here's a little tax trick. It was actually came from somebody, one of my clients said, oh, you know what? My friend has the Costco points. You know what they do with the Costco points? She has it transfers to her grandson's 529 college fund every year. So
wait, you can convert points into cash?
You can convert points into cash. So what they did was they sent it to my Bank of America account. Okay. And I'll just set that money aside and, that money's going to get taken out and go into my child's 529 plan, which is the college savings fund. Because it's money I'm not going to use and it's free money.
Right.
So why not put that towards his college or put that in a brokerage account, put that in a Roth for your kid? There's so many things we could do smart to avoid taxes in the future. So let me segue into the strategy here. There's two separate strategies with the similar outcomes. So, Gary, I don't own tax clarity software. So if I'm about to do anything, let's say if I'm going to buy a car, and am I going to go to the Ford dealer, the Ford website and find my favorite car? Or am I going to want to maybe look at the Kelley Blue Book or Consumer Reports?
I would do all of it.
You do all of it.
Yeah.
Right. What's Ford going to want me to buy, though?
Everything. They're gonna sell you everything. The undercoating, the rust protection.
Oh, right. But what kind of car, though? Whose car they want? It's going to be who? If you go to the Ford dealership.
You're going to buy a Ford.
You're going to buy a Ford, right?
Yeah.
So I obviously don't have anything proprietary. So if we're going to do anything, we want first party or third party as our source. Right? Yep. Third party. So anyway, long story short, I'm going to give you an example of this tax clarity software that we use. And it's a couple A, a married couple. They're 65. Mm-hmm. Okay. They have Social Security income of $33,000 a year, $33,000 a year, $2,000 in ordinary income. Now, ordinary income are things like ordinary dividends or bank interest. Okay. We're actually starting to get some bank interest again. And then they have a $45,000 IRA distribution, which is essentially probably a required minimum distribution. Or they're pulling money from a traditional IRA, which is taxable, not a Roth. Okay. And they're in the 22 bracket, okay? They owe $4,666 on that money by just doing it that strategy, by using that strategy to get their income for the year, okay?
Yikes.
So it doesn't sound terrible, but it's still painful. So let's look at married couple B. Now this, again, tax clarity software, same scenario, same data, okay? Mm-hmm. And all we're going to do, Gary, is take the money out differently from different areas of pockets of money that we all have, okay? Now, not all of us have that. Some of us are just stuck in IRAs. It's terrible planning. Unfortunately, it's great you save the money, but, the tax man is going to come fighting for that money. And there are strategies I'll detail that could have been done at an earlier age, maybe starting at age 60, that could have dramatically lowered that tax bill, okay? But let me just go through this one. So we talked about them. The couple A was $4,666. Couple B is married. Same $80,000 income, same Social Security of $33,000, but the other $47,000 is coming from different sources. $2,000 from ordinary income, like bank interest, $12,000 from the traditional IRA, okay, the taxable one, $33,000 from their brokerage account, which is non-qualified, which is not tax sheltered, but that's things like capital gains. You can pay anywhere between 0 and 20%, right? So depending on your income. And then they're in the 22% tax bracket. That couple had zero taxes that year because of the way they planned.
Same scenario.
Same exact
Two
scenario.
Different outcomes.
Same income, same outcome.
Different outcomes.
Different outcome.
Yeah.
And all they had to do was plan. Okay? Ahead. And then So there's another example. So that's tax clarity.
Let me just do this really quick. Folks, you're listening to On the Mark with Mark Papa from Financial Resources Group. Check them out online at frplan.com. That's frplan.com. And write this phone number down. It's 860-657-8380. That's his office number. By the way, I'll repeat that in about 6 minutes when we wrap things up here. Mark, please continue.
All right. So I'm going to give you one other example here, Gary. And it's a different scenario. It's the same, but it's the same thing. Different company came up with a study, major firm, trillion. I think they manage $9 trillion roughly, and they're doing this for clients that are in the know. So anyway, let's say you had a simple math. You had $200,000 in stocks and bonds or brokerage account. Okay, then you had $250,000 in, let's say, a traditional IRA, the taxable kind, and then you had $50,000 in a Roth. Okay, tax-free. The people who were to take all their money from their traditional IRA, okay, over the lifetime, I think it was over a 20-year retirement, something in that neighborhood, would have paid a total of $65,000 in taxes on their money, their retirements, versus doing it proportional. So what you do is we take a piece from the Roth, so let's say you pull 5% of the value of the Roth, 5% of the value from the brokerage, and then 5% from your traditional IRA, as long as it's less than what your minimum, as long as you meet your required minimum distribution, you do that. You have no choice but to take that. But then the remaining money from your Roth and your brokerage account, you dramatically lower your tax bill. And I have cold, hard cases in my office of people who've done this and watched their tax bracket just melt, go way down, just because of the way they drew their money. Because the traditional conventional wisdom says spend all your taxable assets first, and it's not the way it works. So if you want to do that, then great. You're going to pay the government and tip the government a lot. If you want to recapture some of those taxes for the future and look at a different way, give me a call, and it's 860-657-8380. Also, www.frplan.com. You could see a tab on there called Taxes and Retirement. Also, my other website, not to continue, is glastaxpro.com. And on there, I detail additional tax savings opportunities for people. And all you're doing is just thinking out of the box. We're not talking about foreign trusts. We're not talking about doing special, anything, special taxes or buying money, losing businesses or buying trailer parks in Florida. We're talking about basic stuff here. Okay. It would be okay if I give you a couple of additional examples, Gary.
Yeah, please. You got about 4 minutes.
Actually done. So a lot of people own trusts. So you have living trusts, and then when the first person or the husband passes away, and sometimes they're what's called an irrevocable trust. Irrevocable trusts become taxable at a very, very low threshold at the full tax rate of 35%. So at $11,500 of income, anything above and beyond that gets taxed very, very heavily. It's like a trust fund baby tax. Okay. I've been in situations where I've actually seen people pay income through the trust when they could have passed it on to the beneficiaries. And what happens is you can pass on capital gains and dividends. It has to be written into the contract, obviously, of the trust, that you're able to pass those on. Instead of paying at the trust tax rate, let's say you had 3 beneficiaries, or you had a trustee who can take income, and then 2 or 3 beneficiaries, you can take that same dollar amount and spread it among those 3, and then they were able to pay the taxes at their individual rates versus that very onerous 35% tax rate at the trust level. And that's not hard to do. It's just a matter of thinking through and helping people understand that you don't want your trust to pay the tax. You want to spread it out to the beneficiaries and, in a way, form of a gift, but they pay at a much lower rate. So we've done that and saved significant money for people. And their accountant was a fancy firm outside of Washington, D.C., and they were dealing with some pretty heavy hitters. This was not, not even mom and pop CPA in the corner. This was I guess you'd call a white shoe, right, high end place that they got recommended to. And the partners were probably just having the junior associates do the tax returns and weren't paying attention. We got a hold of it because this woman was paying us like $40,000 every year, and at least $40,000, and we were able to give that money back to her, and then she can actually save it for her family. And now that's every year, Gary. So we're not talking about someone who's poor, but someone who shouldn't be paying. No one should be paying a penny more than they are entitled to pay, but more so, you shouldn't be paying money in unnecessary taxes on money you're not even using.
What valuable information this is.
Thank you, Gary.
This is stuff that most people aren't even aware of. I got to wrap this up in 1 minute, but take the next 60 seconds however you'd like.
Sure. Again, I think all you really need to do is give me the opportunity to review your tax returns. Again, I've been doing this since 2006. I've seen a lot. I've seen a lot in that almost 20-year, well, actually more than 20-year period, almost 20 years. And then I've actually had the ability to fix the problem and show you how the problem is going to be fixed the way you want it fixed. So with my tax clarity software, I can show you the different scenarios. Do a Roth, don't do a Roth. How much if I'm going to do a Roth? How do I stay in that tax bracket? How's that going to affect the taxes on my Social Security? What if we can run it till the cows come home, and I can show you exactly what your percentage is going to pay. And I can get laser accurate on that.
That's incredible. All the more reason, folks, for you to tune into this show each and every Saturday morning right at this time. Basically, what you're getting here that you're not getting anywhere else is financial and non-financial stuff that advisors, they don't tell you. They're really the little things that often get overlooked. I want you to do this. I want you to head on over to their website, Mark Papa's website with Financial Resources Group. It's www.frplan. That's frplan.com. When it comes to taxes, he's got another website he mentioned earlier, too. It's glasstaxpro.com. But glass, only one S, because they're in Glastonbury. It has nothing to do with glass as in windows. GLAS. taxpro.com. By the way, if you're on YouTube, he's got his own YouTube channel. It's Mark with a K, Papa with two P's, Mark Papa 5207 when you're on YouTube. And by the way, write this phone number down and more importantly, use it. 860-657-8380. Once again, that's 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Mark Papa from Financial Resources Group. Until next weekend, have a good one, everybody. So long.